Right. So looking at the live market action right out of the gate today, August 1st, 2026, Zeta Global is trading at $21.60 a share. It's up just slightly, about 1% today.
Yeah, sitting right between that 52-week low of 1436 and the high of 2595.
Exactly. But here is the massive catalyst, the main hook for today's audio summary for Market Pulse Daily. This company has posted 19 consecutive beat and raise quarters.
19. I mean, that kind of flawless execution is just staggering, especially considering the market still treats them with this massive trust gap.
Right. They are practically printing money with real AI, and yet they trade at this crazy discount. We are going to unpack all of that. But really quickly, for you listening, welcome to Market Pulse Daily. Just a quick reminder, you can find a special 14-day trial link for StockOracle down below in the description.
Yeah, and if you haven't checked it out, StockOracle is this incredible AI-aided stock research platform for fundamentals, valuation estimates, moat analysis, bull and bear insights, comparisons, watch lists, and portfolio research.
It's heavily integrated into how we do our research. Though we do need to put out the standard disclaimer. StockOracle is not financial advice. It's not a buy or sell recommendation or, a trading signal service or real-time market data.
Right, and keep in mind that AI insights and valuation estimates can be incomplete or wrong, and the data may be delayed, so always make sure to verify important facts yourself.
Definitely. Also, that link in the description is an affiliate link, so the channel may earn a commission at no extra cost to you if you use it.
Okay, so getting back to Zeta Global, let's talk about why we're even looking at this right now, because the fundamentals are just, well, they're wild.
Yeah, okay, let's unpack this. Because I spent all morning looking at their first quarter 2026 numbers, and I honestly had to double-check my screen. Q1 revenue came in at $396.3 million.
Which is almost a 50% increase year over year, 49.9% to be exact.
Right. And they beat analysts' forecasts by over 7%. And management didn't just stop there. They raised the full year 2026 guidance to a staggering $1.785 billion in revenue.
This is the difference between what I like to call narrative AI and actual cash-generating AI.
Yeah, like every company out there is slapping AI onto their press releases, right?
Exactly. Everyone wants the AI multiple, but Zeta is actually throwing off free cash flow. They did $42 million in free cash flow in Q1 alone, which was a 48% jump from last year.
So if they are practically printing money with these numbers, why aren't they a household name like NVIDIA? I mean, are they just this hidden business-to-business engine that everyday consumers just never see?
That's exactly it. The anonymity is kind of by design. They operate underneath all the brands you interact with every single day. And to understand how they are growing so fast, we have to look at what they call the Zeta supergraph.
Right, the supergraph. It sounds, I don't know, like a weapon from a sci-fi movie.
Right, it totally does. But what's fascinating here is that it's essentially an in-house data lake. It maps out all these random consumer touch points to a single persistent profile.
Wait, break that down for me. Like, how does that actually work in practice?
Okay, so think about how messy tracking is online. You might look at some shoes on your phone, then read an email about them on your work laptop, and then actually buy them on your tablet a few days later.
And to a normal ad agency, I just look like three completely different people, right?
Exactly. They use probabilistic matching. They buy these isolated, expensive data fragments from third parties and just kind of guess that it's the same person. It's expensive and it's wrong a lot.
So instead of a company renting a billboard and just, hoping you drive by, Zeta basically owns the road, the car, and the GPS.
That is a great way to put it. Because Zeta built direct integrations over a decade, they own the data natively. It's deterministic, not probabilistic.
It's like, if standard advertising is just scattered Polaroid pictures, the supergraph is that detective's corkboard with the red string connecting all the pictures together.
Yes, proving it's the exact same person without having to pay crazy third-party data licenses.
Which explains their retention rate. I saw their net revenue retention, their NRR, is at 120.0%.
That number is huge. It means their existing clients are spending 20% more with them every single year.
Because leaving would be a nightmare, right? Once a company integrates this into their CRM, leaving is like trying to tear out the foundation of a house without destroying the building.
You'd have to rip out your entire marketing architecture and go to a competitor who has worse data. It's massive institutional lock-in.
Okay, but data is just data. What are they actively doing right now to push that 50% top-line growth.
Well, that's where their new agentic AI comes in. They call it Athena.
Agentic AI.
Yeah.
We hear generative AI all the time, making pictures or writing text, but agentic means it actually has agency. It does things.
Right. It doesn't just draft an email for you to approve. It drafts the email,
Yeah.
analyzes the best time to send it, sends it out, monitors who opens it, and then automatically adjusts the follow-up without a human ever clicking a button.
So it's literally doing the job of a marketing team.
And doing it at a scale humans can't comprehend. When they launched Athena to general availability, they saw a 7x sequential increase in interactions in the first week.
Wow, wait, really? A 7x jump just in week 1?
Yeah, that's why their super skilled customers, the ones paying over $1 million a year, grew 19% year over year. They are taking bigger bites out of enterprise budgets.
Okay, so the tech is super sticky. But how do they get new customers? Because, having great tech doesn't always equal great sales.
To solve that, they made 2 huge strategic moves recently. First was the Palantir partnership on June 23, 2026.
Right. They are re-architecting the Zeta data cloud onto Palantir's Foundry platform. But initially, I thought that was just like an IT upgrade, just moving servers around.
A lot of people thought that, but it's actually a massive go-to-market strategy. Palantir builds these complex ontology models, basically digital maps that connect random data points.
Like teaching a computer that looking at golf clubs on Tuesday and buying a luxury watch on Friday means it's the same buyer profile.
Exactly. Zeta is supercharging their supergraph with Palantir's mapping. But the real genius is the sales distribution. Palantir has this elite enterprise sales force, and it's a 7-year partnership where Palantir is actively selling Zeta's product to their own clients.
Oh, wow. So they just drafted off Palantir's entire sales team. Management said that could generate over $100 million in annual recurring revenue, right?
Yep, over $100 million in ARR just from that pipeline.
Here's where it gets really interesting, though, and I want to push back on this. Because in late July 2026, they closed a $1 billion credit facility.
$1 billion is a serious amount of capital.
It is a massive war chest. Is this actually a sign of strength? Or are they gearing up to recklessly swallow smaller competitors just to artificially keep this crazy growth rate up?
Yeah.
M&A integrations fail all the time.
It's a valid fear. Capital misallocation is a real risk when you have $1 billion burning a hole in your pocket. But honestly, it's about optionality.
So they don't have to dilute current shareholders to make a move.
Exactly. They can do M&A or share repurchases without diluting the equity. And the fact that lenders gave them $1 billion proved their underlying cash flow is rock solid.
Okay, so if the tech is this good and the war chest is full, we have to talk about market sentiment. Why is the stock still down nearly 16.8% from its June highs? Why the discount?
It all comes down to a trust gap. And we have to talk about the bear case here, the downside risks. Back in November 2024, Culper Research put out a really aggressive short report.
Ah, right. And that triggered the usual class action lawsuits, creating this massive overhang.
Exactly. Even though Zeta has posted huge audited growth since then, the market has a long memory. That's why Zeta trades at just 11.6 times EV to EBITDA.
Which is wildly low for a software company growing at 50%.
Unbelievably low. Comparable application platforms trade at 30 or 40 times cash flow. This raises an important question. What does the market think Zeta actually is?
Right, because they are being priced like a legacy ad tech company, like a low-margin commodity broker rather than a high-margin enterprise software platform.
Yes, a SaaS platform.
Yeah.
But to be fair to the skeptics, the short sellers do have a mathematical point when it comes to profitability.
Yeah, I was looking at their trailing 12-month net margin, and it's actually a negative 1.61%. We can't ignore that.
Yeah.
If the data is as good as they claim, why the lingering smoke?
It's the stock-based compensation. That's the real drag. They hand out a lot of stock to employees, which hurts their GAAP earnings. In Q1 2026, they had a GAAP net loss of $13.25 million.
So they are technically losing money on the books, diluting shareholders to pay for this growth.
That's the bear argument. But that $13 million loss was actually a massive improvement from a $21.6 million loss the year before. And here is the catalyst for the rest of 2026.
They promised GAAP profitability, didn't they?
Yes. Management guided that they will hit positive GAAP net income for the full year 2026.
If they cross that line, if they become undeniably profitable on the books, that completely shatters the short seller narrative.
Exactly. It's a classic standoff. If they hit that goal, we could see a massive upward re-rating as Wall Street finally treats them like a SaaS platform.
So we really need to watch their Q2 earnings coming up in late August or early September. The street wants 420.5 million in revenue. If they do a 20th consecutive beat and raise, that discount could vanish.
It really could.
So wrapping up our final outlook on the pros and cons here for Market Pulse Daily, the upside case is incredibly strong. Sticky technology, 50% growth, the Palantir pipeline, and a cheap valuation.
But the downside risks are real. The stock-based compensation is heavy, the short seller overhang still scares away some institutions, and there is execution risk if they misuse that billion-dollar credit facility.
Absolutely. The burden of proof is totally on management right now. Before we head out, make sure you subscribe so you don't miss our upcoming audio summaries. And again, you can try out Stock Oracle using the 14-day trial link in the description.
And I want to leave you with a final thought on all this. Putting the stock price and the multiples aside for a second. Think about the power of the Zeta supergraph and that Athena AI we just discussed.
The red string connecting everything.
Yeah. If an AI can perfectly map billions of messy consumer data points into a single profile and automatically generate campaigns based on your exact habits, at what point does it know what you want to buy before you even realize you want it?
Wow. Yeah, that's slightly terrifying.
Right. What does that mean for our digital privacy going forward when agentic AI is just running in the background of everything we do?
Something to think about the next time a perfectly timed ad pops up on your phone. Thanks for listening, and we'll see you next time.